Hey, good morning everyone, and a special welcome to all of our new traders. I had quite a few who have joined this week, and it's great having you here. And I wanted to post a video talking about the hidden time and delta connection, because I think this is a really important topic for the new traders. Now, I've, in roundabout ways, talked about this. There was another video called The Benefits of Short-Term Options, and there's a lot of different ways we could spin this title. But the most important point to get from this is that options are tools. And what I mean by that is that each expiration and each strike carries different pros and cons. They are all trade-offs, because if there weren't, there would be what's called an arbitrage between them. So you, as the trader, must fit your outlook and your risk tolerances to each strategy. And so that's why it's wrong if somebody says, oh, you should only use longer dated options, or you should only use vertical spreads. It's not true. They might not be the right tool for that job. So once again, a lot of times new traders hear that short-term options are risky, long-term options are the best. And for the most part, I would agree with that. I think people need to stick with the longer dated options for a number of reasons. But I also understand that it is completely wrong to say that there are no benefits in the short term. So what are some of the benefits of using a short-term option, specifically the trade-offs with time and delta? So here's a graph, and I've got various stock prices across the bottom, and we've got a pricing model set to a strike price of 100 and 30 days to expiration with 20% volatility. And what you're looking at here is what's called a delta curve. It's showing you what the deltas would be at these various stock prices. So I think most of you know that if the stock is at 100 and at the money option, we trace a line straight up, and right where it touches this solid blue curve, it's about 50. And that's true. Your at the money options will usually have a delta of about 50. So based on the way that I've drawn this with 30 days to expiration, where will we start to hit a delta of 1? Well, it looks like maybe up around a stock price of close to 115. And so that solid line is showing what those deltas will be at various stock prices. Now, the bell-shaped curve is your gamma curve. And for those of you who understand the math will realize that these are really just reflections of each other. This gamma curve is derived from this one. But the thing that I want to show now is that for this at the money option with 30 days to go, if you were to look at your gamma, it would be at about 0.4. And if you looked at your delta, it would be right there at about 0.5. So let's now change the pricing model to 180 days. We're going to keep everything else the same strike, same volatility, but we're now going to make it a 180-day option. And we look like this. Now you might have noticed that this red curve, the solid one, flattened out a little bit. And our bell curve, the gamma curve, got shorter and wider. And that will always be true if you increase time to expiration or if volatility increases. But what I want you to see right here is for the at the money strike, what's the gamma? Also 0.40. What's the delta? Also a half. And so this might lead some traders to say, well, they're both the same. They have the same gamma, they have the same delta. Well, it's only partly true. They have the same delta and gamma now, but as time passes, as volatility changes, and as the stock price changes, that is not going to be true. And that's a little hard to see, but that's what you need to understand to better match your strategies with your outlooks. So let's just overlay the two delta curves. And now we can see a very big difference. The shorter term option in blue has a much steeper rise. It gets to delta 1 much faster than a longer dated option. And that makes sense because once it becomes in the money with very little time to go, the crowd's more certain that it's going to stay in the money. And so that's what we're seeing here is that the shorter dated option accelerates those deltas much faster when compared to a longer dated one. So let's look at some examples. Let's say the stock is at 105. So right here, the longer dated option has a delta of 66. But the shorter dated option would be up here at 81. Both call options, both the same underlying stock, same strikes, but they have different expirations. And look at the difference in the way that they perform in terms of the deltas. Now, what would happen if the stock is up at 110? The longer dated option will have a delta of only 77, while the short-term option will be way up here at 95. So that's only a 10% move in the stock, and look at the difference in those deltas. Now we're up to an 18 delta difference. So you can see if we look at these two lines vertically, that gap gets bigger and bigger, and then it will start to narrow as they start approaching delta 1, but that would require the options to be super, super deep in the money before that long-dated option became delta 1. So you can see if we get way out here to maybe 135, now they both have a delta of about 99. They won't technically be identical. You'd have to go out 4 or 5 decimals to see the differences. But for all practical purposes, they are identical. But look at how far the stock had to rise to make them both equal. Now we could look at this chart a different way. We could look at the numbers horizontally. So let's say that we were interested in an 80 delta. Where will that happen? Well, if we come out here to the blue curve, the shorter dated option, that's going to happen at a stock price of 105. But on the longer dated option, I have to come way out here to a stock price of 112. So I need 7 points more movement in the stock to get that same 80 delta. Well, if the stock is currently at 100, that's a big move. So the main thing to see is that even though it might not be readily apparent, every single expiration and every single strike has different characteristics, and some traders might find them beneficial in certain cases, and other traders might find them to be a risk. So it just depends on what you're trying to do, what your risk tolerances are, but the thing to understand is that all options behave differently. And if you really want to make the best of your options trading, you need to understand all of these hidden benefits. And some of the most powerful are the hidden benefits between time and delta. And for anyone who'd like to learn more about the arts and science of options trading, please check out the Alpha Trader course, Strategy Lab, a brand new technical analysis course, and that's all at optionsatoz.com. Also, please join us on the Facebook trading group, Options A to Z, and you can find a link in the description below.